After 10 consecutive increases, the US Federal Reserve has decided to pause the federal funds rate, which is currently in the range of 5% to 5.25%. It has also signaled that this may not be the end of its interest rate hikes. What does this mean? Let us take a look at it in this video. The federal funds rate is the rate at which commercial banks in the US lend money held in the Federal Reserve System to each other on an overnight basis. In March 2022, the Fed started raising this rate. It has also been gradually taking out the money it has printed and pumped into the financial system over the years. These moves help drive up interest rates to discourage individual consumption and investment by firms. The Fed expects the federal funds rate to be at 5.4% to 5.6% by end 2023. So there is at least one hike left, given the current range of 5% to 5.25%. It isn't done with hikes, primarily because inflation remains higher than its target level of 2%. In April, the Core Personal Consumption Expenditures (PCE) index, the Fed's preferred measure of inflation, which excludes food and fuel, went up 4.7%, against 5% in April 2022. It's expected to fall to 3.9% by the end of 2023. So, inflation has been coming down slowly, which explains why the Fed isn't done raising rates yet. The housing sector is already feeling the impact of higher rates, with the median sales price of houses sold in the US falling from an all-time high of $479,500 during October to December to $436,800 during January to March. But controlling broader demand and spending will take more time. The Fed has kept open the option of raising rates again. Nonetheless, if inflation keeps falling, it may become very difficult to make the case for this. So, the bigger question is, when will the Fed start cutting rates? Answering this question isn't easy either, given that the Fed expects core PCE inflation to be at 2.6% at the end of 2024 and at 2.2% at the end of 2025, higher than its 2% target. In the aftermath of the COVID pandemic, the Federal Reserve cut interest rates to almost 0%, leading to foreign portfolio investors buying a record $37 billion of worth of stocks in 2020-21. Their buying has slowed since. The VC money in startups has since dried up, forcing many of them to fire employees. Only interest rate cuts in the US could change this situation.